Hyperscaler debt. It remains a big story. What can I tell you? I mean, there are more people who are putting out notes about it today and making comments on social media. I'm going to go through a couple because we always cite Michael Hartnett of Bank of America when he puts out notes related to the market. He says that being short hyperscaler bonds is a top trade for 2026 as their spreads have widened while cash flow has become insufficient to finance the AI buildout. He looks at the flow show note from Friday to make that assessment, does Michael Hartnett. How about this? This is more from that. In September and October alone, debt issuance from 3 firms was larger than the preceding 3 years combined for big tech issuance. And here we go with Michael Burry again, who posts once again on social media, me then, me now. We have this? I think we do. There it is. Me then, me now. Oh, well, it worked out. It will work out. That, of course, Christian Bale playing Michael Burry in The Big Short. He was right then. Will he be right now? Who knows? Jim Chanos has joined the party. He wants a little action, too, because he posts on social media talking about CoreWeave specifically, and again, this idea of depreciation, whether it is being accurately assessed. So Chanos is in the mix. Burry is in the mix. There's a lot of concern about what's been happening with Oracle. Credit default swaps spiking there. Meta CDS just came to market, and Seema Modi is following all of that because we want to know more. Seema.
Scott, all of this focus on artificial intelligence debt that is being used to build out the infrastructure, investors are starting to buy some protection or hedge their bets. Here's Oracle's 5-year credit default swap now at a 2-year high, volumes also notably rising in the past week. Barclays analyst Andrew Keaches, in a note to clients, writes Oracle's negative free cash flow and aggressive capex explains what we're seeing here. He also calls out Meta and its recent dip into the debt market to fund its data center expansion, though notes that its use of off-balance debt facilities is unique and worth noting. Of the major hyperscalers, Amazon and Microsoft have not taken out any new debt, and analysts say they carry a much stronger free cash flow outlook and therefore have less pressure to do so. And that's really showing up in the credit rating, Scott, of all the companies. They're all investment grade, Oracle notably at BBB. So one to watch.
And one to discuss. Seema, thank you very much. That's Seema Modi. You have a take?
I do.
I want to take from everybody on this.
This is the battleground stock, Oracle.
Oracle?
Absolutely, as it relates to AI and the conversation that we've been having on the network for the last several years, where we have confidently stated it is different than 99, and I believe it is different than 99. But the reason that we've cited, the justification was because the innovation funding was coming from cash from operations, not from debt like it was in 99. The market is sensitive to any form of debt funding the innovation, and that is the problem that we see with Oracle. The parabolic high at 345 on September 10th, the day after that AI announcement, is completely washed away. The stock is actually now lower than the day of that announcement.
That's right.
September 9th, it was 250. It's now 228. So the market is saying we don't want that kind of behavior. And Oracle,
in this name. Well,
it's justified in this name because the debt to equity ratio on this company is nearly 550%. That's not something you should be comfortable with.
You made the argument yesterday with Lebenthal, that Farmer Jim, that this was much ado about nothing, all this borrowing and debt issuance from the hyperscalers to fund the build-out.
In some issues, the hyperscalers, thinking of Meta in particular, I don't think it is anything to get worked up about. They've got the cash flow. They can turn it on or off. With CoreWeave, it's a name I never liked. I was surprised at the move it had post the IPO, given their concentration on one client, and it really is a dead end.
It's a hot market. NeoCloud is like
exactly.
a hot thing.
Right, so now you're taking the excess out, and now you're going under the hood to see what are those deals they've made with OpenAI or whoever, what are the real finances that are underpinning that, the financial plan. And by the way, they don't pass the smell test. So that's true of Oracle. So you can rifle shot shorts, but I think that if you're going after Meta, and I don't know who is, I think you're crazy because there's no there. There's no trigger you can identify. It's going to say, wow, they've defaulted on a payment. Now, keep in mind also, it's been pretty slow in the high yield market, and the credit market for all these funds over the last few years. So they're glomming onto something.
Sure, but
that helps it.
This is not a today problem.
No, it's not.
Right?
It's not.
But at some point down the road, you may look back and say, I should have paid more attention to Burry's X storm.
On certain names, correct. But what I'm saying is not the ones I own, and that's not coincident, okay?
So I'm going to speak with a broad brush, right, to just the AI trade in general, tech companies in general. The entire premise of this run-up and the defense that has been made for a lot of these companies and all the spending that they're doing is that they had these enormous cash positions. They have now drained a lot of those cash positions. And again, I'm speaking with a broad brush. I know that there are idiosyncrasies.
Well, they
with
haven't
all
really
these companies.
drained them. They haven't
come
drained
down.
them.
They've come down because they've spent.
The hyperscalers are still sitting on mountains of money. Let's not act like they spent it all the way down.
Agreed.
All the hyperscalers.
Sitting on it, yes. But then why do they need debt if they're sitting on the cash?
Because it's cheap enough for them.
Okay. So moving forward, if there is, this is not even necessarily just a warning sign that there's more debt. If we start having more debt in the system, in these stocks, in these particular names that the entire economy is looking at, that the entire stock market is looking at, then we have to pay more attention going forward. Scott, to your point, this isn't a today problem. Going forward on credit spreads, on CDX, on everything that the debt market will tell us about when and where the stress may begin.
Spreads have widened by like 80 basis points.
But because of the regional bank stress, not because of this.
No. The hyperscaler spreads have widened by about 80 basis points. If you look at the chart, it tells a story. I mean, yes, they're issuing a lot of debt, but they also have the best balance sheets around. They're the most resilient companies around, which is why people look at even the widening, which is small relative to historical standards, and say, it's not the big deal that people would like to make it out to be.
Let's put it in context.
It's not. It's not.
Well, we on Oracle, we bought it before September 9th, had the big run up, now it's down 31%. To say that it's the poster child for this question about when is too much debt going to really hit the stocks hard, it's hit this stock because Oracle was new to the party, right? New as a member of this elite group. They have a huge backlog in sales. And if that comes through to them, they're going to be just fine. The big issue, in our opinion, is whether the economy is holding up enough so that there's business for everybody to go around. If the employment numbers continue to weaken, and we don't know what to believe or not to believe about the labor market because we don't have any numbers, we're going to start to get those numbers again. And that, to me, is the issue with whether the debt on these companies is totally fine or whether we have a problem.
I'm not saying they're not going to be. I'm not saying they're not going to be fine. What I'm saying is, first of all, if you're a CFO right now from a hyperscaler, I don't think you're using debt. I think you're using the cash from because you learned your lesson with Oracle. What I'm saying is it blunts the sentiment and confidence surrounding the story that's been told for the better part of the last 2 years. That you don't have to worry about this because this is
the hyperscalers
all
are
cash
tapping the
from
debt
innovation.
Market, what do you mean?
It's
not Oracle.
Not to the degree that Oracle.
No. But I mean, we're still talking about tens of billions of dollars worth of paper. We are.
Oracle was by far the leading issuer in terms of overall supply.
Yeah, but you're saying, well, CFOs of hyperscalers are using the cash. I mean, they're raising debt.
I think
I could give you a chart.
And I would think from after seeing the effect on Oracle moving forward, I think you'd be hesitant as a CFO to continue.
I think you'd be irresponsible as a CFO not to take out debt if you're a Meta, because your cost of
Meta's fine.
Your cost of debt is around 2%. Their bonds go up to 5% or so. And versus the cost of equity to use, it's much higher. So you're supposed to take out debt when you're a CFO
Apple's used
at a
debt for
cash flowing
years.
company.